7 rules inside the federal tax code punish parents who help their own children. And together, they pull more than $10 billion of wealth out of American families every year. The worst part is that almost none of them make the evening news. No fraud, no scheme, just parents writing checks, paying tuition, loaning money, and signing their names next to their children's names on ordinary family documents, and finding out, sometimes decades later, that the government had a rule nobody bothered to explain. 5 of these rules are written in plain English. You could read them in an afternoon. The other 2 are buried in paragraphs the size of a small phone book, and that second category is where the largest losses happen. One of them, the third rule on this list, routinely costs families more than $100,000 on a single transfer. And in higher bracket states, it has crossed $200,000. The parents who triggered it were absolutely convinced they were doing the smartest thing possible for their kids. If you have ever helped a child with a down payment, written a check for a wedding, loaned money for a business, paid for college, or put a grandchild's name on a savings account, at least one of these rules applies to you. But the consequence almost never shows up in the year you wrote the check. It shows up 5 years later, 10 years later, or only after you are gone and your children discover what the transfer actually cost them when they try to sell, when they apply for long-term care coverage, or when the estate files its final return. Therefore, what follows is the briefing you should have gotten before you wrote that first check. 7 federal rules in order of how often they catch ordinary families, specific dollar figures, real code sections, and at the end, the 5 moves that stop all 7 before they ever fire. The first rule is the $19,000 trigger for the current tax year. The annual gift tax exclusion sits at $19,000 per recipient per giver. That is how much money one parent can give to one child in a calendar year before a federal filing is required. A married couple can double that because each spouse has their own annual exclusion. So, a husband and wife giving to one adult son have $38,000 of annual room before any filing obligation begins. That sounds simple. The problem is what happens the moment you cross it. Suppose a mother writes her son a check for $25,000 to help with a down payment. She has not broken any law. She does not owe any tax on the gift, but she has just triggered a mandatory federal filing. She must file Form 709. The federal gift tax return, with her regular tax return the following April. If she does not, the Internal Revenue Service can assess a failure to file penalty equal to 5% of the unreported amount per month, capped at 25% plus interest. Here's the part that catches nearly every family. The gift itself is almost never taxable. The $6,000 above the exclusion simply applies against her lifetime exemption, which, under current federal law, sits well above $13 million per person. So, in the year of the gift, nothing comes out of her pocket. The Internal Revenue Service does not send a bill. Everything feels fine. Therefore, thousands of families skip the filing entirely because no consequence appeared. But the filing is the permanent record the Internal Revenue Service uses to track how much of the lifetime exemption a person has already consumed. Without that record, when a parent dies, the estate must retroactively reconstruct every undocumented gift from bank statements and wire records. If reconstruction is incomplete, the default assumption is not favorable to the estate. Consider the scenario of a retired couple in their early 70s who gave each of their 3 adult children $50,000 across 2 years, $300,000 in undocumented gifts. No filings. The husband passed unexpectedly. The estate attorney had to reconstruct 4 prior years of gift tax returns, pay late filing penalties, and defend the lifetime exemption math with 10-year-old statements. Total legal and filing cost, roughly $12,000. None of that was the gift tax itself. The gift tax was zero. It was all the cost of never having filed in the first place. Therefore, the rule is this. Any gift to any one person above $19,000 in a calendar year must be reported on Form 709, even when no tax is owed, and both spouses must each file if both gave. The second rule is the 5-year lookback. This one is not administered by the Internal Revenue Service. It is administered by Medicaid, but the consequences fall on the same families for the same reason, and the rule was written into federal law by the Deficit Reduction Act of 2005. That statute extended the Medicaid lookback window from 3 years to 5 years, which means that when a parent applies for long-term nursing home coverage through Medicaid, the agency will demand 5 full years of bank records, real estate records, and financial statements, and examine every transfer for fair market value. Any gift inside that 5-year window triggers a penalty period of ineligibility. The penalty is calculated by dividing the gifted amount by a monthly nursing home care figure set by each state, which typically runs between $7,000 and $14,000 per month. The result is the number of months the applicant must pay for their own care out of pocket before Medicaid coverage begins. The rule does not care why the gift was made. It does not care if the child needed the money for a genuine emergency. If the transfer happened within the 5-year window and no fair market value came back in exchange, it counts as a gift. Consider the scenario of a widow in her late 70s who gave her daughter $40,000 as a wedding contribution. She had roughly $700,000 in savings at the time. 2 years later, a sudden stroke placed her in a skilled nursing facility at roughly $11,000 per month. She applied for Medicaid once her private funds began running low. The lookback caught the $40,000 gift. Her state divided $40,000 by a monthly care figure of $10,000, producing 4 months of ineligibility. She paid out of pocket for those 4 months at roughly $44,000, more than the original gift itself. Now, the mitigation here is real, but it lives on a timeline. Transfers made more than 5 years before an application do not count against the lookback. Therefore, elder law attorneys will often structure long-term protection plans that move assets outside the parent's estate well before any care is likely to be needed. But those plans must be set up before the 5-year clock starts, not during a crisis. Therefore, the rule is this: any gift inside a rolling 5-year window can cost the parent months of long-term care coverage, even when the parent had more than enough money to begin with. The third rule is the one that costs families the most money, and it is the reason the opening of this briefing said, "A single rule has cost families more than $100,000 on a single transfer." It is the stepped-up basis destruction. Under Internal Revenue Code Section 1014, any asset inherited at death receives what tax professionals call a stepped-up basis. That means the cost basis for capital gains purposes resets to the fair market value on the day the original owner died. A stock that a father bought for $10,000 that has grown to $150,000 by the time he passes is inherited by his son with a new basis of $150,000. If the son sells it the next day for $150,000, the capital gain is zero. No federal tax, no state tax. But the step-up only happens at death. If the father gives the same stock to his son during his lifetime, there is no step-up. The son inherits the father's original basis of $10,000. If the son sells at $150,000, the capital gain is $140,000. At current federal long-term capital gains rates of 15 to 20% plus state income tax, plus the 3.8% net investment income tax that applies at higher incomes, the total bill can easily exceed $30,000 on a gift everyone assumed was free. Therefore, the lifetime gift destroyed roughly $30,000 that inheritance would have preserved entirely, and that is for a modest stockholding. The damage becomes catastrophic on real estate. Consider the scenario of a father in his mid-70s who wanted to help his only son with home ownership. He owned a vacation condominium worth roughly $500,000, purchased decades earlier for $80,000. His attorney recommended transferring the deed directly to his son so the property would avoid probate. The transfer was recorded. Neither of them knew what had just happened to the tax basis. 2 years later, the father passed. The son sold the condominium for roughly $550,000. Because the deed had been transferred during the father's lifetime, the son's cost basis was the father's original $80,000. The taxable capital gain was $470,000. Federal tax, state tax, and the net investment income tax combined to a bill in the range of $110,000. And because the father's primary residence was a different home, the Section 121 exclusion did not apply. Had the father kept the deed in his own name and passed the condominium through a will or a revocable trust at death, the son would have inherited with a basis of $500,000. The gain on sale would have been $50,000, not $470,000. Total tax would have landed closer to $10,000 or $12,000. Therefore, the rule is this: gifting appreciated property during life transfers the original cost basis. Inheriting the same property at death resets the basis to fair market value. The difference between those two outcomes on a single property routinely exceeds $100,000. The fourth rule is the kiddie tax. This one catches grandparents even more often than parents, but the cost falls on the family either way. The kiddie tax treats unearned income on assets held in a minor child's name or in a student child's name under age 24 at the parent's top marginal tax rate once that unearned income crosses a small threshold. For the current tax year, the threshold sits at roughly $2,700 of unearned income per child per year. Below that, The income is either tax-free or taxed at the child's own low rate. Above it, the income is taxed at the parent's rate, which, for a middle-class household, commonly lands at 24 or 32%, and for a higher-income household, can reach 37%. The trap is that grandparents routinely fund custodial accounts known as UTMA or UGMA accounts, with the idea that the assets will grow at the child's low tax rate for decades. That is not how the rule works. The child's low rate applies only to the first few $1,000s of annual unearned income. Everything above is clawed back to the parent's rate. Consider the scenario of a retired couple who funded a $100,000 custodial brokerage account for their granddaughter at age 12, invested in dividend-paying stocks generating roughly 4% in qualified dividends annually. That produces $4,000 of unearned income per year. The first $2,700 is sheltered. The remaining $1,300 is taxed at the parent's marginal rate, if those parents are in the 32% bracket. The annual kiddie tax bill is roughly $416, compounding to thousands over time. The damage is worse if the account produces concentrated capital gains in a single year. A sale of appreciated stock inside a custodial account can push $20,000 or $30,000 of unearned income into a single tax year, taxed at the parent's rate. There is also a secondary trap. UTMA accounts legally become the child's property at the age of majority, which in most places is 18 or 21. Once that date passes, the child has full legal control of every dollar. The grandparents cannot claw it back. A family that funded the account expecting college tuition has no legal authority if the child decides at 18 to buy a car or stop attending school. Therefore, the rule is this: money placed in a child's name for tax purposes is taxed at the parent's rate above a very small annual threshold, and it legally belongs to the child the day they reach adulthood. A properly structured 529 plan, or a trust drafted by an estate attorney, can often accomplish the same goal without either consequence. The fifth rule is the non-arm's length sale. This one is triggered when a parent sells something to a child for less than fair market value. The most common version involves real estate. A mother decides to sell her primary residence to her adult daughter at a discount because the daughter is struggling with the local housing market. The house has a fair market value of $350,000. The mother sells for $200,000. On paper, this looks like a helpful parent making life easier for her kid. The federal tax code looks at the same transaction very differently. Under the gift tax rules, any transfer of property for less than full and adequate consideration is treated as a gift for the difference. The $150,000 discount is classified as a gift from mother to daughter and must be reported on Form 709, consuming $150,000 of the mother's lifetime exemption. But the deeper problem is what happens to the mother's Section 121 exclusion, the rule that lets a homeowner exclude up to $250,000 of capital gain on the sale of a primary residence, or $500,000 for a married couple. A discounted sale to a family member compromises that exclusion and is often recharacterized as a partial gift and partial sale. The mother may owe capital gains tax on the portion treated as a sale because the gain is measured against fair market value rather than the family price. The mother had originally paid $80,000 for the home decades earlier. The transaction is viewed as $200,000 of sale plus $150,000 of gift. Because the sale portion is below fair market value, some portion of the Section 121 shield can be disallowed, and her taxable long-term capital gain can land between $40,000 and $80,000, producing a federal and state tax bill between $6,000 and $18,000. And the daughter, as a buyer from a related party, inherits the mother's original cost basis for the sale portion, plus a carryover basis on the gift portion. When the daughter eventually sells, she is sitting on a gain equal to her sale price minus $80,000, with no step up at all. The combined generational tax bill on one well-intentioned family sale can exceed $70,000. Therefore, the rule is this: selling property to a child below fair market value is treated by the tax code as a combined sale and gift, with tax consequences on both sides of the transaction and a potential loss of the normal homeowner exclusion. An elder law attorney or a qualified tax professional can structure a family transfer that preserves the exclusion, but the discounted sale on a handshake almost never does. The sixth rule is the tuition and medical payment exception, and this one cuts two ways. Under Internal Revenue Code Section 2503, subsection E, there is an unlimited exemption from gift tax for payments made directly to a qualified educational institution for tuition or directly to a medical provider for medical care. This is one of the most generous provisions in the entire gift tax system. A grandparent can pay a grandchild's $100,000 graduate school tuition in full, and not $1 of it counts as a gift. Not against the annual exclusion, not against the lifetime exemption, not anywhere. But the exception has a razor edge. The payment must go directly to the institution. Directly if the grandparent writes a check to the grandchild, who then writes a check to the university. The entire payment is a taxable gift from the grandparent to the grandchild, subject to the normal $19,000 annual exclusion and lifetime exemption rules. Consider the scenario of a grandmother who wrote a $45,000 check to her granddaughter at the start of the fall semester to cover tuition and room and board. The granddaughter deposited the check and paid the university from her own account. From the granddaughter's perspective, the money went to tuition. From the federal tax code's perspective, it went to the granddaughter. The entire $45,000 counts as a taxable gift. $26,000 of it is above the annual exclusion and must be reported on Form 709. And the exception under Section 2503, subsection E, is lost entirely because the payment did not go directly to the institution. The medical side of the rule is identical. A parent can pay a child's $50,000 surgery bill tax-free so long as the check goes directly to the hospital, the surgeon, or the insurer. Reimbursing the child afterwards does not qualify. Sending money in advance to cover anticipated medical bills does not qualify. Room and board at a university does not qualify either. Only tuition qualifies for the educational exception. A grandparent who pays a $40,000 tuition bill directly to the school and a separate $15,000 housing bill directly to the housing office has made an unlimited tax-free tuition gift of $40,000 and a $15,000 ordinary gift. Therefore, the rule is this: payments made directly to the institution or to the medical provider are unlimited and tax-free under the federal tax code. Payments made to the child or reimbursements made afterward are ordinary taxable gifts, subject to the annual exclusion. The difference between those two outcomes on a single tuition year can convert a completely tax-free transfer into a $60,000 gift tax filing obligation. The seventh rule is the intra-family loan trap. This one catches families who try to structure financial help as a loan rather than a gift, usually because the parent wants the child to feel the weight of the obligation, or because the child wants to buy a home without bank financing. The structure is almost always wrong. Under Internal Revenue Code Section 7872, any loan between family members must charge interest at least equal to the applicable federal rate, often shortened to AFR. The AFR is published every month by the Treasury in 3 tiers: short-term for loans under 3 years, mid-term for loans of 3 to 9 years, long-term for loans beyond 9 years. In recent periods, mid-term rates have commonly run in the range of 4 to 5%. If a parent loans a child money at 0%, or at a token rate well below the AFR, the Internal Revenue Service applies a concept called imputed interest. It calculates what the interest should have been at the AFR and treats that uncollected interest as both income to the parent and a gift from the parent to the child. So a 0% loan is not a tax-free loan. It is a loan that generates phantom interest income for the lender and a tracked gift for the borrower. Consider the scenario of a father who loaned his son $80,000 to start a small business. No interest, no formal note, just a spreadsheet. The loan surfaced on the father's bank statements during a later examination of his returns. At a 4% AFR, $80,000 generates roughly $3,200 of imputed interest per year. The father owed ordinary income tax on $3,200 of income he never actually received for every year the loan was outstanding. Over 5 years, that added roughly $16,000 of taxable income to his returns. And because no formal note existed, there was also the risk of recharacterization of the entire principal as a gift at the point the loan went into default. There is a narrow exception. Loans under $10,000 between family members are generally exempt from imputed interest rules, provided the loan is not used to buy income-producing property. Loans under $100,000 have a reduced imputed interest rule tied to the borrower's net investment income. But above that threshold, the AFR rule applies in full. Therefore, the rule is this: money loaned between family members without a written note, without a stated interest rate at least equal to the applicable federal rate, and without scheduled payments is not a tax-free loan. It is a combination of phantom interest income and a tracked gift, and it can be reconstructed years after the original transfer. The 7 rules just covered cost American families a combined figure that runs into the billions every year. But the mitigation for all 7 fits into 5 concrete actions, and every one of them routes through a licensed professional rather than through a tax hotline or a weekend internet search. First, for any gift above the annual exclusion of $19,000 per recipient, per giver, file Form 709 in the year of the gift, regardless of whether any tax is owed. A qualified tax professional or an enrolled agent can prepare the return, commonly for a few $100s, and the filing prevents a reconstruction nightmare later. Second, for any gift or transfer that could fall inside a 5-year Medicaid lookback window, speak with a state-licensed elder law attorney before the transfer, not after. Protection plans must be set up before the clock starts, not during a crisis. The attorney fee for a full plan commonly falls in the range of $2,500 to $6,000. Third, before gifting any appreciated asset during life, whether stock, real estate, or business interests, consult a qualified tax professional about the Section 1014 stepped-up basis. In most cases, the inheritance path preserves dramatically more wealth than the lifetime gift path. Fourth, for any payment intended to help a child or grandchild with education or medical care, route the payment directly to the institution or the provider, never through the child's account. The Section 2503, subsection E exception requires direct payment. Fifth, for any loan between family members, have a certified tax professional or an estate attorney draft a formal promissory note. Set the interest rate at or above the published applicable federal rate for the month the loan is made, and record scheduled payments. Those are the 7 rules. Those are the 5 defenses.